Welcome to Lloyd's Canada Virtual Roadshow series, showcasing Lloyd's leading underwriters by class of business and a few selected partners. My name is Asima Zahid, and I'm Director for Market Development at Lloyd's Canada. Today's session kicks off the class of business focused discussion on casualty with leading underwriters from Lloyd's market, showcasing our syndicate, Aegis, Brit, and QBE. When it comes to casualty class, it is no surprise that Lloyd's is a leader in the Canadian insurance market. Approximately 29% of our premiums come from casualty, making it the largest line for Lloyd's in Canada. However, 2020 was a challenging year for the casualty class, and we're hoping to demystify some of the questions you have been itching to ask the underwriters, as most of you haven't been able to travel to London. Therefore, we're bringing London to you with our discussion today, led by Christina Leung. Christina is a senior casualty broker within Marsh Global Placement Team, located in Calgary, with a principal focus on clients with multinational exposures and complex risk profiles, primarily in the midstream energy, energy services, and power and utility sectors. We also have three leading Lloyd's underwriters with us on the panel today. Jon Hiller is a commercial liability expert and portfolio manager for QBE's Canadian casualty and international EIL portfolios. An active underwriter himself, Jon also leads a team of casualty underwriters in London, UK, Toronto, and Vancouver. In addition to servicing Canadian brokers, Jon and his team provide support and capacity to numerous wholesaler and binder holders. Over the last 15 years, Jon has worked in both the Lloyd's London market and Australia in a variety of roles, including claims, underwriting, strategic, and portfolio management. Jon's specialisms are in niche and specialty tailored programs, delegated authorities, and global and multinational placements. We also have with us Martin King from Aegis. Martin began his career in 1982 as a broker with CT Bowring before moving into underwriting in 1988 to specialize in professional indemnity. Martin has developed a niche PI portfolio over the past 20 years and joined Aegis London in 2015 after 11 years at Novi Syndicate, where he managed their professional indemnity account. Last but not least, we have Tom Hillier with us today. Tom is the managing director for specialty business at Brit Syndicate, responsible for a broad range of businesses, including casualty, marine, energy, renewable energy, and space. Tom has been with Brit for 8 years, fulfilling various roles during that period. Prior to his time at Brit, he spent 8 years with ACE European Group, which is now Chubb, laterally as the London casualty manager. Tom has a broad experience of both the London and company market in London, spanning over 20 years. Tom originally started in the insurance industry, specializing in environmental liability, working at AIG for a short period following a postgraduate role with the London-based engineer consultancy. Now, before I turn it over to Christina, I would like to remind our listeners to use the Q&A tool to ask any questions you have for our panelists. Christina, over to you.
Hi, Asima. Thank you very much for the introduction. Before we start with the panel discussions, I'd like to take the opportunity to first provide an overview of what we're experiencing in the Canadian market. Over the last 3 years, we've seen a gradual hardening of the market, with certain industries seeing harder than average conditions. While there have been other hard market cycles experienced in the past, this one appears to be prolonged due to various exacerbating factors such as social inflation, global pandemic, climate change, and more recently, cyber incidents. This has all led to reduced capacity, rate increases, and more restrictive coverage for our clients. While we all just want to know when this is all going to end, none of us have a crystal ball. So the best that we can do is to have a discussion to better understand some of these items that are impacting our clients. So let's start off with COVID-19, as it's a topic that is top of mind globally. How have your businesses been impacted by COVID-19? And can you give us an overview of the current market conditions from your perspective? Jon, do you want to kick us off?
Yes, thanks, Christina. And firstly, thanks for the intro. And I'm pleased to be here with so many familiar, maybe not faces, but people in the audience. So we're really looking forward to some engaging debate and some good Q&A, Christina and Asima. So we hope you find it interesting. Well, it's been one of the most challenging environments to navigate, I would say, due to COVID coinciding, colliding, or even driving to some extent the hardening market. You know, it's an increasingly fragmented and a market, I would say, that's in transition. I'd probably break it down into three areas. You know, firstly, you know, in terms of exposure, it may be a long time before we know the true impact of COVID on our business. You know, we have seen losses for sure. You know, we have been looking at scenarios internally and with some of our customers. But exposure is something that's going to take time for us to determine and to play out ultimately. Secondly, there's the obvious impact. You know, we can no longer trade face to face in London, and that's been an adjustment in the way we transact and interact. There's pros and cons to that, but I do feel it's been conducive to better decision making, a focus on better data and information based underwriting. There's been more flexible working patterns, which in the UK, dealing with Canadian business can be dangerous. Obviously, the further west you go, the later the evenings can drag on. But it can work for many, you know, and it can work well for many of our customers and cover holders too. We believe it's led to enhanced service to many customers and cover holders, particularly. Our wholesale operation in London was very Lloyd's trading floor focused. So now with MS Teams and Zoom, obviously we can't travel, but we feel a lot closer to our partners and our cover holders and customers as well. And then thirdly, of course, there's the general market conditions, which, you know, due to where the market is at the moment, you know, it's led to an increase in submission flow. You know, we've seen more than 3 times the number of submissions that we would in an ordinary year. And through being able to be laser focused on our underwriting, we've actually managed to grow quite substantially. So that's a positive for us. But we can't always offer the service we'd like to for all potential or new customers just purely because of the volume we're seeing. And then lastly, there's been a rapid transition to digital trading and placement. You know, PPL helps us with that hugely, helps us to track what we have outstanding. And other Lloyds and QBE initiatives support that: data capture, data cleansing, and data quality, all which drive better underwriting decisions based on experience and risk profile. So it's been a turbulent time for sure all round. You know, I've experienced nothing like it, but it's been really fantastic getting to know the marketplace and more of our customers.
Thank you, Jon. Martin, would you like to have a comment?
Yeah, I don't think I'm going to say quite as much as Jon, so but here goes. I think when I think of COVID, it literally turned everything upside down, and we all thought, what on earth are we going to be doing? And it probably took everyone, I would say, 3 to 6 months to really regain their bearings. You know, we were all sent home early March in the UK, and it came as quite a shock. And I know from my own experience, the sun was shining, which is quite a rare thing in the United Kingdom. So it didn't quite feel so bad. But then you had to get your head around, how are we going to do the business? And I'm a very, I've sat on Lloyd's box for, 30 years, day in, day out. So I'm one of the few that's there morning, noon and night. I'm normally on an aeroplane twice a month, as I've got clients all over the world with a big chunk in Canada. So I'm normally certainly on the east coast of Canada once a quarter. And it just came to a grinding halt. And I found the whole thing fairly concerning. But what it did show was that there are businesses that are geared to survive this type of turmoil. And, you know, it could be COVID by another name. And if you're in a business that's run like a tight ship, which Lloyd's is, and you have to remember, Lloyd has gone through more than COVID in over 320 years. And we've always bounced back. And we have really focused on our customers. Probably the most important word when I speak about underwriting is that of continuity, providing the service, not running for cover, not hiding behind your laptop and the emails, trying to be as highly visible as we possibly could. So, you know, we engage like everyone else in Teams and Zoom and any other sort of video medium. But it was really difficult in order to be able to get your message over, because you can say things on an email and the client or the broker or both of them don't really believe what you've written. And you can even have a video call and you can get the same response. You might get a little bit more traction in the video call, but there is no substitute for being in the same room, eyeballing the other party, them eyeballing you to see whether you're telling the truth or not. And this is, I think, the main barrier, and it still remains until we can get on aeroplanes. And what it's done, it's really tested those long-term relationships. So if you thought you had a long-term relationship and it wasn't quite as tough and strong and robust as you thought it was, you've probably lost the business. And if you've got a proper relationship, and relationships, I always feel, are built up over anything over a 5-year period, and you exchange blows through the cycle. You know, you get a stinging claim today, but hopefully you get some of your money back tomorrow. And the test of the relationship is obviously the client prepared to pay the increased rate. So that helps to dig you out of the hole. But we haven't been able to get in the room with the client and the broker to be able to express properly why we do what we do. The electronic trading aspect, I think, has literally saved us. We have something called PPL. It's not brilliant, but it does what it says on the tin. Aligned to that, some agencies, Aegis is one of them, developed online trading system to augment, supplement our traditional business lines. And I think when it comes to electronic trading, underwriters and the insurance industry per se are normally the last people to join the party. And COVID has really forced our arm. If you're not properly engaged in either transacting electronically or at least putting your shoulder to the wheel to have an online trading system, I think over the next 5 years, you'll possibly be left behind. And that's my piece.
Thanks, Martin. Some comments from you, Tom?
Thank you, Christina. I'll try and keep it fairly short because I know we've got a lot to get through. I guess just going back to the impact of COVID itself on the casualty market, I think probably we haven't been impacted from the claims activity that perhaps other areas have seen when you look at, you know, property BI and you look at this contingency market. But I think we have to bear in mind that we write a long tail class of business. And you know, manifestation of claims, you know, may not be something that has come to the fore just yet. You know, the nature of the business we write means that, you know, we're effectively writing business now that we might not be paying the claims for you know 5 or 10 years. So there's uncertainty still there, and I think that's something in casualty classes that we have to be really mindful of. I think, as the other gentlemen have said, it's been you know, quite a different experience for all of us in terms of finding an alternative way to deliver solutions to our clients. But I think, if nothing else, fairly holistically, what's being demonstrated is the resilience of Lloyd's, and where some felt that Lloyd's hasn't been able to adapt to change over time. I think we've clearly demonstrated that actually, we've made a pretty good job of being able to adapt to delivering and maintaining a service to both our kind of our broker community and our respective clients. So that is certainly a message that I would like to leave with everyone, that hopefully Lloyd's collectively has demonstrated that ability to be resilient.
Thanks, Tom. And a reminder to everyone on the call that you can use the Q&A for additional questions. Many of our clients are facing unprecedented challenges, and with the hard market, we are seeing continued pressure on rate increases, lower tolerance for risk, and less capacity. Can each of you offer some remarks on what lies ahead in terms of capacity and capital, and how we can best work together to help our clients get through this time, and perhaps comment on what challenges you're seeing, particularly with respect to managing your budgets, and what can be done or what is being done to stabilize the market? Tom?
Thank you, Christina. So obviously there's clearly been a firming of the casualty market and the broader market, and that's not just in Canada. That is a global phenomenon. I don't think it's necessarily being driven by a shortfall in capital, but really driven by a sustained period of underperformance from not just the Lloyd's market, but the broader insurance market. And that's really what's driven this requirement for a shift in pricing and a drive for pricing adequacy to be achieved. Ultimately, we see ourselves as insurers as kind of long-term partners of our clients and brokers. And in order to offer that level of sustainability, we have to get that pricing adequacy correct. And I think the case has been that's not necessarily been there over this kind of very sustained, long, soft market that we've seen, certainly up until kind of 2018, 2019. I think, again, I come back to the point I made earlier, the casualty classes are long tail classes of business. So again, we're pricing for risk for claims that potentially will be presented in the future. So we have to factor in things like inflation, things like the uncertainty that comes with paying a claim in 5 or 10 years' time. So I think really what from my perspective, we're very much there to continue supporting our clients, but we very much have to be able to do that at a profitable level. Like any other business, we're ultimately here, to deliver a profit to our shareholders. And in order to do that, that means that, again, that pricing adequacy is really important for us. I do think that if you look at the solutions that are still being delivered by the broader Lloyd's market, they're focused on ensuring profitability. I think there's a flight to quality. So we're looking to partner with those brokers and clients who can deliver us good data, good information about our insureds, demonstrate good risk management. So it's really back to the underwriting and the importance of underwriting discipline and making sure that we can continue with a client for that sustained period of time. Martin referenced, that long-term relationship. That long-term relationship is reliant on both parties, being able to sustain through that relationship. Certainly from a Brit perspective, we have planned growth through 2021, growth that we expect to then roll into 2022 as well. So we expect to grow with our partners, with our brokers, with our clients. Hopefully a very good example of that and how we're trying to support our clients and brokers through a fairly difficult period of time is, many of you will have seen in the press, we've recently released the first algorithm-driven follow syndicate into Lloyd's called Key. And again, that's introducing new capital to the market which is an automatic follow. And there'll be those of you out there who have already hopefully experienced the benefit of having that automatic follow capacity offered to your clients in support of Brit lead business. So again, I think it's a demonstration of Brit and the Lloyd's market trying to be innovators in the insurance space so that we can continue to deliver solutions, through a relatively difficult period.
Thank you, Tom. Jon?
Yeah, thank you. So I agree with Tom. I think there's no major capital shortage. What we're seeing at the minute is performance driven. I understand that there are challenges with certain programs, with capacity, and we have been right sizing our lines on many programs, and that might affect specific clients. But in the aggregate, we've grown our portfolio quite substantially, and we have the support of QBE and Lloyd's to do so. So from a budgeting perspective, we manage income and budgets at a higher level, a broader product level, multi-products. We do need constant engagement, and there's a lot of reforecasting, which takes up a lot of time. But we have seen growth beyond rate, as well. I know a lot of people suggest that the growth we've seen is purely because of the rating adjustments, but we have seen that. So we've seen true organic growth, and we feel like we're continually stepping up to support on new programs and new cover holders in what's a challenging time. Filling gaps in programs and supporting others in the market, collaboratively, as is the tradition of Lloyd's. And we feel that there should always be, some solution. There might be disagreement in terms of, where we are in terms of pricing or terms and conditions, etc. But we always try and offer some support, unless it's a class we have a particularly poor experience in. We feel that most risks can be underwritten if they're given proper consideration. In terms of stabilising the market a little bit, which I think is what you're alluding to and what may be needed, sustainable underwriting is critical. I think so. To Tom's point, it's a long tail class. Our development of our portfolio goes beyond 10 years even. And so the impact of those fiercely competitive underwriting years, is clear to see. Some of our records suggest that pricing is only really getting back to 2013, 2014 levels. Pricing was considerably higher if we go back on many programs, further in time. And since that time alone, we've seen material adverse development on prior year. We're still seeing adverse development, not just in our portfolio, but we're seeing that on our peers' loss experience too. So we know that, many people are experiencing that. If you then overlay social inflation and new exposures, we'll come on to cyber at some point shortly. We feel like we have a far greater risk, and rates aren't quite adequate yet in many areas. So in short, I think there's a little bit more work to be done, particularly in some of the poorest performing sectors. But of course, we're seeing some flattening off in others too, where there have been a few years of compound rate increases. So, I feel like there's a little bit more work to be done, but we're getting there. We're getting there slowly.
Thanks, Jon. Martin?
Yes, the words I say are particular to the errors and omissions space. This is my fourth hard market, or my fourth cycle. And the previous three were all driven by reinsurers, because the original insurers had given the reinsurance market unsustainable loss patterns, and they put our prices up at the back end, and then we passed those costs on the front end. So quite a simple and easily explained way. When you're talking to a client, my cost of my treaty have gone up by X, therefore your cost is going to go up by the same amount. Because to do anything different would be selling yourself short. This cycle is very different from the previous three, because it was driven by Lloyd's. Lloyd's had a thematic review in 2015 when it called in all of the underwriters writing into the international E&O space. Basically said the results were dire. And the market continued in the same vein for another 3 years. And then it called us in again in 2018 and said, look, we asked politely, you've done nothing, and now we're going to tell you. And we went through a very difficult business planning session in 2018, where numerous business plans had to be resubmitted a couple of times. And the end result was a number of markets pulled out of writing in the errors and omissions space. So Lloyd's, they refer to international errors and omissions as being a decile 10 business. E&O has been on the naughty step at Lloyd's for the past 3 years. And let me tell you, it is still there. And the results, quite frankly, have just not been good enough. Capital has become scarce because what's happened is the managing agents have reallocated their capital from E&O into other lines of business that were producing a better return. Managing agents also have to bear in mind the cost of capital. And when you write short tail business, the cost of capital is a lot lower than when you write long tail business. So if both the long tail and the short tail are producing the same underwriting result, if the cost of capital is half for one than it is for the other, you can see very quickly where they're going to allocate their capital. And it's not to the long tail lines. In Canada, Canada joined the hard market party late. It only joined this year for E&O, from my own perspective. So it still has a fair way to go. And I think when you have hard markets, the brokers and the clients all want to know, what's the price going to be today and tomorrow? And how long is this going to last? And these are very difficult questions to answer. In other parts of the world, we've had 3 years of compound rate increase, and Canada is only in year 1. So you could say maybe Canada's got another 2 years of consecutive rate increase, but it all depends on the underwriting result of the business. We at Aegis, we're very committed to Canada. We've been in the Canadian space for over 20 years. We've continued to offer our renewal clients continuity. We haven't gone into hiding or anything else. And the end result of that is that our business volume has grown in terms of premium income, but also by numbers of clients. Just touching on premium income, Lloyd's syndicates are governed by their premium income limit. It's an odd environment that is not experienced outside of Lloyd's. Each syndicate has a set defined income limit over which they're not allowed to write. Otherwise, there are penalties. And within the syndicate, each lines of business have their own separate, identified, defined premium income limits. And again, those must not be exceeded. What happens when the market hardens is that the rate increase and the organic growth of the client, it eats into this premium income increase. And it's very difficult for the underwriter to be able to budget accurately for the flow of new business that comes in through the front door. And we have to be very careful how much business we take on board. But we're not able to write everything, and neither would we want to write everything. We tend to find that when the market first hardens in a territory, all the risks from the bottom drawer from the broker get thrown across the pond, and they tend to be the slightly more difficult risks that the local market doesn't want to write. And those are clearly the risks that we don't want to write either. So we tend to straight back those, and we wait for the second and third wave of what we would consider to be vanilla risk that comes into London. So we max out on our renewal portfolio. We support them as best as we are able. And then we have limited additional income space with which we're able to consider new business, but it's not income unlimited. And the harder the market becomes, the more difficult it is for the Lloyd syndicates to keep writing the new business, because obviously the renewal portfolio is the thing that they look after first. Why has the market hardened the way that it has? Well, we had 15 or 16 years of compound rate reduction, and eventually it takes its toll. And I was a bit like a broken record, speaking to brokers, saying that the deeper the cuts go in terms of rate, the sharper the rise will come on the other end. And you need to advise your clients to be squirreling away their rate saving in the softer years, because when the market turns the other way, we have a lot of ground to make up. You know, if you consider Canada had 15 years of compound rate reduction, and the rates have only gone up by 15% this year, it's peanuts by comparison to the way the rate went down over the prior 15 years. The market, though, is stabilising. The only difficulty I think the underwriters face presently in the E&O is, have we got enough premium income to last us for the end of the year? And you will find in the second half of the year, certainly in Q4, there'll be less available income in order to be able to consider new business that comes from any part of the world. But that's all about portfolio management. It's also something that keeps the market on its toes and keeps the market rate the way that it is. Just sort of going off script a little bit, I have quite a few chats like this, and occasionally with regulators. And it tends to be the underwriters who are in situ in a hard market that get hit with the stick by the broker. And really the stick should be applied to the underwriters who pulled out, run away, got fired, who will then start up again in 2 or 3 years' time. They've escaped, quite literally, with blue murder. And the likes of the panel here, we're sat in the hot seat in a very uncomfortable environment. The amount of times that people say to me, wow, hard market, you must be singing like a bird in the tree. No, I'm not. And neither are any of my peer group, because we're looking after the back years, we're managing our income, we're managing client expectation. And what tends to happen is we'll have a risk that comes across our desk that we've never written, and we've steered away from that particular subgroup for about the past 10 years, because economically it was suicide to write. But there's no one else to go to. So it comes to us. And all we do is we dust off our base rate that we've always charged, but it just happens to be 3 times the rate of what was charged last year to the underwriter who's run away. And it looks like we're skinning the client, and we're not. We're just charging a true base rate to earn a fair underwriting profit. And I think a lot of this gets lost in a hard market. Underwriters are perceived as egregiously rating business, when in fact they're not. You know, they are looking after their jobs. They're providing a service for today and tomorrow.
Thank you for sticking around for all of our clients. With the increased number of cyber incidents that have occurred over the past year, another item that is top of mind is cyber. Over the past couple of years, Lloyds have taken a position that cyber coverage can no longer be silent. Then there have been various versions of the cyber exclusions introduced with varying degrees of exclusionary languages. Can each of you comment on how you've been addressing the coverage and what our clients can do in order to achieve coverage for both non-malicious and malicious acts? Jon, if you could take that one first, that would be great.
Yeah, sure. Thanks, Christina. Look, first of all, I think the position taken by Lloyds is a positive one. And we should be supportive of positive positions on cover as opposed to silent. Fundamentally, clarity and consistency in wordings is key. Ambiguity is not helpful for anybody. But it's not just Lloyd's, it's the regulators too, the PRA and APRA, who ultimately governs QBE's headquarter in Australia. They're looking to protect the stability and the integrity of financial markets. In terms of the regulators, it isn't just insurance, it's for the protection of the system and ultimately the end customer. So, I think a cyber event, is likely to be or could easily be a systemic one. And that could be, a capital event, such as we haven't seen as yet in the recent market. And it would be far more damaging than the sort of conditions we've seen over the last couple of years. So in terms of what QB are doing, we always try and offer the broadest cover that we can and that we can get comfortable with. But it remains a fact that, there are risks and there are many areas that we simply just can't offer cover for, within the pricing and, within the confines of what we're able to charge to the customer ultimately. You've only got to look at, the exclusion lists, on the policies to see, what previously has been an issue and it's no longer, granted cover for largely. Lloyd's carriers, I feel, are typically more favourable when it comes to terms and conditions. You typically see fewer exclusions on a Lloyd's slip than you might in a typical domestic market, and that's true for the UK too. We can offer varying levels of buyback, where we're comfortable with the sector, the risk of the information provided, the risk profile of that customer and that sector. And we're continuing to develop a strategy. It's not just something we just worked on and that's it. We've just launched a new questionnaire for higher risk sectors. And fundamentally, we encourage the debate around cyber risk, but the exposure has to be considered and properly underwritten, which it hasn't historically been done. And at a time when the landscape, the cyber landscape and the risk environment for cyber risks and exposures have been evolving quite rapidly, it's just something that hasn't been given proper, due consideration, I don't feel, and it ultimately hasn't been priced in as that landscape and that risk environment has changed. And I think that's why you're seeing the reaction that we are right now. So what can brokers do and what can cover holders do? I'd say, obtain good risk information, engage early, and most importantly, have more strategic discussions with carriers to understand their positions and their concerns and why they're taking a certain stance and what they may or may not be able to offer. And I think that will give you the best opportunity to get the broadest coverage. But fundamentally, it hasn't been priced in and it hasn't been underwritten, and the landscape has just changed fairly drastically, rapidly for cyber risk.
Thanks, John. Martin?
Well, the cyber, again, everything I talk about is in respect of errors and omissions. The cyber market is a rapidly moving place. Over the last 5 or 6 years, it's grown exponentially. It's currently buried in ransomware claims, and the results are terrible. When it comes to an errors and omissions policy, a lot of the policies that I issue are legal liability arising from breach of professional duty. Well, that's as wide as you like. And some policies I issue on an aggregate basis. Some of them are each and every. I write small SME limits, but I'm also on the big towers of the big multinational programs. And the Lloyd's takes its lead from the FCA, Financial Conduct Authority in the UK. And the Financial Conduct Authority mandated that in respect of errors and omissions from the 1st of January this year, we were no longer allowed to be silent in our policy coverage in respect of cyber. We either had to expressly state that we were covering it and mandate a limit, or it had to be excluded. And we had a difficult balancing act because we didn't want to take away the cover that the client had always had. And I only use two clauses, which is the IUA clause and the NMA clause, and happy to send those through if anyone would like copies of those. But those clauses, they provide coverage for indirect cyber liability arising out of breach of professional duty, including things like social engineering. So, for example, a broker receives the funds to pay a claim from an insurer, and his email gets hacked, and he passes the money to the wrong bank account, and then it disappears into the ether. That is an errors and omissions claim, and one that we would cover. It's very close on the line to a trading loss, but the way the market stands, that is covered. What we won't cover is malicious or criminal act. And that really is we never had an intention of covering this. And what the clauses that we now apply on all of our cover, they seek to clarify that we will give cover for indirect cyber liability arising from breach of professional duty. But if there's a malicious or a criminal act, we wouldn't want to cover that anyway. And there's obviously, in the past, there was none of this language of clarification. And it's very easy to say, oh, well, that must have been covered then. But there was a huge grey area, and that area was becoming larger and larger by the growth in the cyber market. And really, if a client needs cover for malicious or criminal act, he should be buying a specific cyber liability policy, and shouldn't be expecting the E&O underwriter to be indemnifying him for this type of exposure.
Comments, Tom?
Thank you. So I guess there's been a lot covered there. I guess from taking two of the points that have been made, I think it's important for everyone to really understand what's driven the need for the affirmative or the position to be taken in terms of silent cyber. It's the systemic nature of cyber as a class of business. It's the potential for aggregation of loss. And the potential unknown ultimately out there for that aggregation could be, fundamentally catastrophic. As Jon alluded to a wider kind of financial system. So I think it's a very responsible step that's been taken, both by the regulators and then obviously adopted by Lloyd's. I think what's probably important then to just highlight, and as Martin's touched on, is there is a maturing standalone cyber market that is really kind of coming to the fore in terms of its capabilities and the extent of coverage that it can provide. Brit, from our perspective, are a market leader on the standalone cyber perspective. We have a whole host of products. We have a cyber center of excellence. We're employing consultants within the business who can give advice beyond the underwriter interaction to clients, so that clients can better understand their exposure, and so that we can manage that exposure with them. So whilst I think it can be perceived as a negative that the whole silent cyber issue has been or the way that it's been addressed, I would say that actually it's a big positive now. Because there's a better understanding. There are experts in the field. There are underwriters who write this business as their day job. That's what their where their expertise lies. So I think the London market is evolving around this topic. Obviously, the topic is evolving on a almost daily basis. So there's an awful lot to keep track of. So having it hidden away in classes of business that aren't intentionally writing that business is not the place for it to be. So I think there should be a more positive view of what the market is trying to do in terms of offer solutions that are designed specifically to address these issues.
Thank you, Tom. And I think a lot of you have already alluded to this, but as part of the future at Lloyd's, the Lloyd's market has been moving towards electronic placement. And this trend seems to be accelerated during COVID-19. How do you anticipate the future of the underwriting room or the virtual underwriting room at Lloyd's, where face-to-face negotiations are still valued at Lloyd's? Jon, do you want to start there?
Sure. Thanks, Christina. Yeah, I mean, when I think of the room, it's a lot of people in one place who can syndicate and deal with complex risk face to face. This is the key. I think face-to-face interactions are of huge value. You can accomplish a hell of a lot more when you're sat in front of somebody, as Martin said, when you look into the eyes. It enables you to build trust and rapport far quickly, and you can get a lot more comfortable with the person. And I think the discussions are, just move a lot of a quicker pace when you're sat in front of somebody. I think we've benefited hugely from, whilst it is challenging, at the other end of a Zoom or a Teams call, it is not the same as being face to face, but we benefited from being able to actually increase those interactions. There's no commute, there's no travel, there's huge focus on our underwriting and most importantly, our interactions with brokers and cover holders and clients. I'm not sure it's sustainable in the long term for the teams, for my team, colleagues. You need proper collaboration, knowledge sharing and learning and development for more junior members of the team. That's absolutely for sure. I haven't actually seen the virtual underwriting room presentations yet, but I'd seen some of the pitches in terms of the tech. So I'm excited to see how that develops. But I think fundamentally, even post COVID and when we get back, hopefully, to a normalized environment where we can go into the underwriting room more freely, I can still see a divergence in how business is traded. I think smaller, homogenous, electronically traded business, SME, micro SME programs or excess capacity driven placements, I can see there being less face-to-face, more data-driven portfolio underwriting, more efficient processes. But when you think about the complex risk and where bespoke underwriting is needed, global placements, for example, more challenging placements that need to be bespoke, I think the face-to-face is going to be absolutely critical. And the time must be and should be saved for those really important interactions and negotiations. We've continued to in the same vein of the underwriting room through, the COVID pandemic, look into the eyes of customers and brokers and to answer their questions and talk about risk. And I think that's the beauty of Lloyd's, and that has continued. I can see that continuing, for a long time to come. The room has reopened, but I think the return will be slow. We're seeing few brokers returning to the City of London, but once the numbers and transmissions slow, and if the vaccines hold up, I think we'll see a gradual, return of brokers to Lloyd's, and we'll see the room pick up, and the virtual room, I think, will become a feature for sure. But I can't comment enough on that. Maybe some of the other guys can touch on the virtual room a little bit more. I'm excited to see what happens with it.
And Tom?
I guess, firstly, I would say, ultimately in the long term, we are still committed to face-to-face business. I think ultimately what we will be looking for is to optimize, the combination of using technology and adopting technology. I think, Brit certainly at the forefront of innovation in that space at the moment, and I think we will continue to look for ways in which we can bring efficiencies to the way that we operate in our industry. I think if nothing else, we've learned through the process of having to deal with COVID and home working, we've realized that there are ways and parts of our business which we can transact in much more effective and efficient ways. And I think you'll continue to see, those solutions evolve. I think there is certainly investment going in from, Lloyd's more broadly. As future of Lloyd's is efficiencies is a key component of that. But I think we all appreciate that there are components of our industry and negotiation that still require that face-to-face interaction, which we wholeheartedly support. I think it's just finding, as I say, that kind of optimal position. Again, I using our example of the algorithm-driven syndicate key that Brit launched earlier this year is a great example of where we're trying to bring those efficiencies. And I guess, that kind of bringing that follow capacity to the market is all about trying to develop solutions that give, our clients and brokers a more effective way of accessing capacity. And hopefully what it also does is, from a lead perspective, it allows our underwriters to, really focus on the areas that they need to be concentrating on, the decisions that require the attention. Jon alluded to the generic risks that are out there. It's trying to find ways of being more effective and efficient, and hopefully bringing some of that business, that perhaps doesn't come to London, the more vanilla business, as Martin mentioned, that we don't always see. Trying to offer ways in which we can provide solutions for that business so that it supports some of those more complex, more challenging risks that come to the market. So I think that there is definitely a solutions-driven mindset. I think there's been a realization from the London market, the Lloyd's market certainly, that there are ways and means in which we can be more effective in the way that we transact business going forward.
Thanks, Tom. Anything to add there, Martin?
A little bit. Try not to go on too long. In terms of electronic trading, the market is mandated really to use PPL or white space. But that's not really electronic trading in its truest form, because the negotiation, whilst it can be undertaken via PPL and white space, it's normally done face-to-face via video link or via email, and then it's backloaded after the event, and then there's an electronic record of what we've all agreed. It's been, whilst it's very clunky, it really has saved our bacon, because if the broker was still having to take around a paper slip, we were having to wet stamp everything, the whole thing would have fallen apart. So we as underwriters were not overly complimentary about PPL, but we do recognise that it saves the day. What is beginning to happen more and more is that each individual syndicate is now beginning to build its own genuine online trading platform. Bit of an advertisement for Aegis. We have something called Opal, and we sell property to liability, cyber, GL, errors and omissions, all on the same platform. And it's genuine internet traded business. We're also the first syndicate to have been able to achieve automatic lineage upload, which is quite a scalp. And I'm sure other syndicates will follow. The SME portfolio that we crave traditionally is written via a binding authority agreement, and it can become a bit of a labour of love in terms of the old paper factory, the bordereau production and everything else. And the online trading is really the next phase. It's a rebirth of the traditional binder that's been placed at Lloyd's for the last 50 years, because it enables you to have real-time analysis. The system creates the bordereau, the cover holder does a lot less for his commission, and the Lloyd's broker has a very light touch as well. It enables us to offer the same service, same quality of capital, but at reduced cost in terms of overall commission. We justify that because there is less touch by the broker and the cover holder. And the key to everything is that everything must make money. I can't make money without the cover holder making money, and neither the broker. And the cover holder and the broker can't make money if I'm losing a shed load. And the electronic traded aspect of the business is a lot more transparent. Just touching on the virtual underwriting room, I went to a presentation last week. It's brilliant. What they're trying to do is they're not trying to extinguish the traditional face-to-face trading that we have at Lloyd's. All Lloyd's is trying to do is to recognise that we are going into a flexible working environment where some offices only have 0.7 of a desk for their employees. So at any one time, 30% of the workforce is going to be at home. It may well be the finance, the actuarial team, but it could also be the underwriters. And what the virtual room enables a Lloyd's broker to do, and the access is via the broker in London or within the UK, it enables the broker to access the calendar of the underwriter to see when he's available. He's not able to see the detail of the underwriter's calendar because obviously that's highly confidential, but there are gaps, and then he can apply for the underwriter to see him. The underwriter also has an ability to say, I'm not going to be virtually trading on Monday and Friday, or could be Tuesday, Wednesday and Thursday, because he's actually going to be at the box. The other interesting byproduct of this is speaking as an underwriter who does an enormous amount of travel. One of the things that brokers find difficult to do is to track me down, and they can get me on email, but there's normally a bit of a delay. But the virtual room can be used by me and the London broker to trade even when I'm on a business trip. And I think it's a fantastic addition to our skill set.
Thanks, Martin, and thank you to the panelists for this Q&A session. We do have some questions from the attendees, and one of them, probably the most relevant, is, as the world starts to emerge from under COVID-19, have you identified any emerging issues or trends that we should keep an eye on? John, did you want to maybe take a stab at it, and somebody else?
Yeah, sure. Yeah, thank you. So, I mean, there's a number of trends and issues that we see coming out of the crisis, but I think one of the biggest ones is the climate crisis that we're seeing. Climate issues are becoming more and more frequent and add a hell of a lot of volatility into our portfolios, and not least the increasing adverse weather events. We sadly have a number of clients who are impacted by the recent wildfires out west, and these fires are accelerating. I think if you look at the 10-year rolling average in terms of hectares burnt per annum over the last decade in Western Canada, it's more than double what it was in the 60s and the 70s, when it averaged 1 million, and now it's at 2.6 million hectares burnt per annum. So it's a serious issue. I think that's been attributed to increasing temperatures, as well as some other factors, but and there are huge social pressures when it comes to climate change that will continue, and they'll continue to impact our industry for sure. Some industries are already seeing some of that climate-related activity, some of the oil majors, for example, and there are new and sort of innovative companies that are being set up in tech and manufacturing space to kind of deal with that, or to attempt to deal with that. But the biggest challenge is for our existing customers, trying to adapt to those pressures and trying to adapt to supporting a lower carbon economy. That can affect companies' human capital, systems, processes, assets. It's a changing exposure, and it's not one that's kind of reducing. It's another exposure that we have to consider, and we are investing, huge efforts in trying to understand the climate risk of the future by industry. And for example, we're building some of these considerations into our underwriting. We're increasingly using wildfire mapping tools to inform our underwriting on power and utilities risks. But the opportunity, I think for QBE and for all of us is to build stronger partnerships with those in transition, support our customers through a transition, and try and, hopefully inform, through our data and analytics capability, try and inform to enable everybody to, and all of our customers to operate more sustainably. So for me, climate issues and the climate crisis is the number one. And I think with the wildfires out west, raging, I think it's probably one of the most topical.
Okay, well, thank you, everyone. Thanks, Jon, for answering that question. And thank you, Christina and the panel, for the excellent and insightful conversation today. It is very clear from the conversation that Lloyd is playing a strong role in Canadian casualty placements. And it's good news to hear that the market is positively responding to and supporting our broker network and policyholders. Now, don't forget to join our next event on August 18th, showcasing our syndicate QBE, where you will be able to learn about their risk appetite, capacity, and strategies in Canada. Thank you again for joining us today. Have a great week.